morning, everyone. I can see some people joining, but I thought I'd introduce myself. My name is I'm Dilip Wagle. I'm a senior partner with McKinsey Company, and this was a piece of work that we did about a year ago or so. So some of the data on housing are somewhat dated. The thesis is still pretty much the same as it was in a pre-COVID day as it is today. If anything, things have gotten a little bit worse. I will share a presentation with you and then I'll lead you through some of the findings. Given the nature of this conference, it's a little bit tricky to know what questions you have. So I'm unfortunately going to have to wait till the end to answer and respond to specifics. But that's the way they've set it up. So I will go through the presentation. Feel free to send any questions over chat, and then the moderator will let me know at about 10 minutes before the end of the session that I can get into specifics on the questions you had. So let me try and share a screen with you because it will help guide this discussion. Okay. I'm assuming because of silence that everybody can see the screen. The work we did on homelessness began as an exercise about 2 years ago and then continued through 2018 and 2019. And so these data come from our work in 2019. There are basically 5 major points that we were able to find when we did this analysis. One was, regardless of what PIT count numbers tell us, which is your point in time count, homelessness continues to be a growing problem in the county. Secondly, we've got ourselves in some sense to be responsible for homelessness because the prosperity of the region is what's driven up rents. This is a supply side problem, not a demand side problem. And the primary driver of homelessness that we were able to find was a lack of or a declining number of affordable rental units, especially for families at the lower income strata. To address this problem, we need to basically create more affordable housing. And this requires some combination of levers, which is in investments in new homes, as well as repurposing of existing structures. You're going to need a whole lot more funding than we have today, and I'll share with you some of the data we analyzed on how much this is, but it's significantly higher than what we have on. If you want to eradicate homelessness, or at least bring it down to some manageable level, we're going to have to fund this to a larger extent than we have today. And then the final piece of analysis we did was to compare homelessness today with the externalities that you have associated with homelessness, which is a loss of tourism, a loss of business revenues, an increase on social services such as healthcare. And it turns out that it costs more to keep people on streets as homeless people than it is to actually remedy it through new construction and building. So all in all, we're better off thinking about this more holistically and trying to address this problem than somehow pushing this under the carpet. Okay, so those are the 5 main points. Let me dive through. This is a pretty data-rich analysis, so forgive me in advance, but there'll be a ton of numbers in this. Let's start with the state of homelessness. Now, these data are until the January of 2019. Through 2014 through 17, you can see homelessness increasing in our PIT count. In 2019, we saw a dip, which in 2020 was actually offset again by a 5% increase. So these data don't have those numbers, but nonetheless, we have seen once more an uptick in homelessness in the county. When you dig deeper, if you look to the right, you see that even though the point in time count, which is a very imperfect method, we in fact, beyond this chart, we never use the data on point in time counts. If you go to the HMIS, which is the Homeless Management Information System run by King County, you actually see that the number of people that have sought homelessness services during the year has actually been continuing to rise even during the pit count dip. And a significant number of these are people that aren't permanently housed. So we have a homelessness problem that's actually quite acute and increasing. So who are the homeless? If you analyze the 22,000 odd people who are homeless, about 30% of them are chronically homeless, which means by hard definitions, they've either been homeless for a year or they've had 3 episodes of, or 4 episodes of homelessness over 3 years. So they're about a third of them are chronically homeless. They are predominantly, 98% of them earn less than $24,000, $25,000 a year, which puts them at the bottom of the pyramid, or 30% or below 30% of the area median income. So if you want to address homelessness, the most important segment to hit is the 0 to 30% of AMI segment. Interestingly enough, even though a lot of our shelter capacity is used towards housing families and youth, the largest chunk of homeless individuals are single adults under 25. So about 60% of them are in that category. And then to the right, you can see the ethnicity and race. This shouldn't be of any surprise, but what is stark over here is that if you look at the African-American population, we have about 6% of the county classified in that category, yet about 27% of the homeless happen to be Black or African-American. So which means that you have a 4x multiple in terms of the proportionality of African-Americans in the homeless population relative to the general population. So this is it's a correlator, not a causative issue, but it's something to keep in mind that race is an important part of this exercise. So why are we homeless? Why do we see homelessness increasing? If you look at King County, now this is pre-COVID days, so there are data that may indicate that we've had a drop in our GDP locally. However, in the pre-COVID days, we were one of the fastest growing metro areas in the nation. In fact, other than San Jose and a few others which were smaller, we had the highest growth rate in terms of GDP for the metro area. If you also look on the right-hand side, our incomes have been growing, our population has not been growing quite as significantly. So there's a trope that gets passed around which says that the reason we have homelessness is because lots of people who are homeless are coming into our county, and that's just not true. First of all, our overall population is not growing quite as rapidly. It's growing around less than 2% per annum, and it hasn't changed very much over the last 10 years. And our median income, if you look at it from 2017 onwards, has actually been escalating much faster than the national average. It's been growing around 6.5% per annum. In King County, our median income is around $109,000 for a family of 4. And that's around 30% higher than the national average. So we have a combination of high growth, low population growth, and a median income that's growing faster than average. So why on earth would we have homelessness in a relatively prosperous region of this nation? Well, this chart may offer some indications to this effect. If you look at the jobs being, the left-hand side shows jobs, population, and housing supply. If you look from 2010 to 2017, the number of jobs created has grown by 21%. So there's plenty of new jobs that are being created in the area. Our population at its steady growth of 1.7% over 10 years actually translates to about a 12% change. So that's a 12% growth over the 2010 to 2017 period. But our housing supply actually has grown only by 8%. By the way, these are not per annum. These are not annual numbers. These are aggregate numbers over that period, 2010 to 2017. Excuse me. So you can see that jobs have grown significantly faster than our housing supply. Now, if you look at the right-hand side, you can see this translated into rents. The median rents on the right-hand side have grown or have gone up 52% between 2010 and 2017. While the household income, if you take all strata from the top to the bottom, have only increased 12%. So now you put the two together and you see that you've got a paucity of housing supply, an increase of a skyrocketing of rents, and a lagging of the aggregate median income. So you can see that this is a prosperous region that still has an issue with housing supply. So how does this translate to people at different strata within the income pyramid? If you look at the left-hand side, you've got the area median income bands. So you can look at some of the data in the middle over here, which says that if you're earning more than 96,000, typically this is either a single software developer or two construction laborers that have a family together. If you look at the bottom of the pyramid, you typically have people earning less than 22,800 a year. And these are generally below, at or below minimum wage. Now, take a look at the dotted line as it translates from left to right, and you can see that the people that are in the 0 to 30% of AMI, the bottom of the column on the left, tend to spend almost 60% of their income on rent. So these are extremely rent-burdened individuals. Even if they were able to find housing, they're spending 60% of their income on rent. Now, by HUD guidelines, we ought to be spending no more than 30% on housing. And yet we've got the bottom of the pyramid spending anywhere from 50 to 60%, and it's increasing on housing. By the way, it's not that it's just the bottom. If you can look at people in the 30 to 50% AMI, these are slightly better off individuals, typically. And these would be spending somewhere between 30 and 50%, or 45 and 50% of their income on rent. And then even more prosperous individuals who are in the 50 to 80% of AMI, typically these would be nurses, administrative assistants, they spend somewhere between 35 and 40% of their income. So every one of these bands is essentially spending more than HUD guidelines would have us understand we should be spending. So we've got a problem in terms of a constrained supply and an increased demand. Let's peel this onion a little further and see where this demand comes from. And I draw your attention to the top and the bottom. The top of the top band over here is the 80 to 100% of AMI band. So these people typically, about half of them, of the 110,000 households in King County in this band, are homeowners. So they own their own homes. About half of them tend to be renters. If you go further down the pyramid, you can see home ownership declining. The dark gray band is the home ownership band, by the way. You can see home ownership declining. As you get to the bottom of the pyramid, you still have about 25% of people owning their own homes. And these are long-standing residents who've retained their homes. About 75% are renters. Now, the interesting thing in this band, there are two things to note. One is, if you take regulated and vouchered units, it's about a third of the total population tends to live in regulated units or use vouchers, which means about 40% of the people living in the 0 to 30% AMI tend to have market rate rentals, which means they're seeking rents, they're seeking units that are at market rate. Now, if you're earning 0 to 30% of AMI and you were to spend what the HUD says you ought to be spending on renting your apartment, you should be renting it at no more than $660 a month. So it's very difficult to find apartments that are market rate rental apartments that are available at 660. In fact, when we looked around last year, we couldn't find a single one in King County that was at that rate. So this is a real problem for the people, the 40% that are trying to earn enough to pay their rents. The other interesting point on this is to look at the number 96,000. That's an important number to keep in mind. That is the total number of households in the 0 to 30% AMI range. So keep that number in mind when we come to the next page, or two pages, page hence. Now take a look at supply. So the page prior to this was the demand, right? So let me just flip back one. This is the demand, 96,000 households in the 0 to 30% AMI seeking housing. This is the supply side. If you look at the supply side between 2010 and you just let your eyes drift over these columns, you can see that the top of the column is the amount of supply that is for people that can afford greater than 100% of the AMI. So people earning more than 109,000. The thing that strikes you is that the amount of housing that is dedicated to people that earn more than 109,000 is actually increasing. You can see it growing from left to right. The light gray column or the light gray portion of the column is actually increasing. If you let your eyes drift further down to the 30 to 50% AMI and the 50 to 80% of AMI, you can see that the gray zones, the lighter gray and then the darker gray, is actually declining. So what we are seeing is essentially a dislocation where there's a decline in the number of units available for people that are in below the 80th percentile of AMI, and an increase in the number of units available for people above the 80% of AMI. So if you take this to its logical forward conclusion, what we find is over the 10-year period from 2010 to 2019, we will have lost essentially 112,000 affordable units. Now, when I say lost, it doesn't mean that these units have disappeared or they've been destroyed by some builder and reconstructed into more expensive housing, though some of it does happen. But the reason we call it lost is because essentially the rents in those units has now gone above the demarcations of the 50 to 80% or the 30 to 50%. So the rents have increased, and that's what causes those units to disappear from the market for that band of demand. So that's important to recognize, that you've got 96,000 people that need homes, and we've got a declining number of available, affordable units that they can house themselves into. Now, there's one number on this page that I'll draw your attention to, which is the number of units available to people that earn less than 30% of AMI. Remember, 98% of the homeless happen to be earning less than 30% of AMI. We have 24,000 units in 2017, and if anything, it's going to be even smaller today. So we've got about 24,000 units available to people in that band. I'll turn to the next page now. Now let's put the demand and supply together. And I'll dwell a bit on this chart because it's an important chart. On the left-hand side, you see the number of affordable units. That's the supply. It's 24,000 affordable units. On the extreme right, you see the total demand. That is the 96,000 households that are seeking housing. So now we've got a problem of trying to figure out how do we squeeze 96,000 people within those 24,000 available units. So let's try to work ourselves from right to left and then left to right. So let's start with demand on the right-hand side. Start with the 96,000. If you remember 2 pages ago, I mentioned there were about a quarter of these people who were homeowners. They're longtime residents who have not left their homes. So those people have already got shelter. So you've got 24,000 who are already homeowners, they're already sheltered. Then you've got about 17,000 households that that receive vouchers. So you've got a combination of 24 and 17 that are essentially housed in places that they either own or they've received vouchers to be in. Then you get to the people that are in the middle, the 55,000 left over from the 96,000. Now, 18,000 of these people are living in households with affordable units. Okay, if you remember, there were some fraction of units that were occupied by people that were in affordable housing units. And these were typically people that were in, had some kind of regulated units that they were living in, or they were long-time residents that had somehow struck a deal with their landlords. Which means that the remaining 37,000 are living in rent-burdened conditions. Okay, so you've got rent burdened, which means that they're spending more than 30% of their income or they're homeless. So you've got 37,000 people that you need to figure out what to do with. Let's move from the left to the right now. On the supply side, you've got 24,000 affordable units. Some of these units, about 6,000 of these are what we call down rented, which means people that have incomes above the 30% of AMI actually live in these units. So they choose to live there for reasons, for various reasons. Some people just prefer lower rent. Some people just didn't want to move. But there are about 6,000 of those that are down rented, which means effectively your supply has gone down to 18,000. So now you've got a problem of trying to house these 37,000 people in a total supply of 18,000. So let me move to the next page. So of these 37,000 extremely low income families, the term ELI refers to people below the 30th percentile in AMI, 16,000 have no permanent housing. So when we did the analysis, we said, look, we've got evidence, fairly strong evidence that this is a supply side problem. If you're going to address the supply side problem, how many units would you need to go build? And it turns out that the answer is somewhere between 16 and 37,000. And the reason is because if you put 16,000 households today, they don't have permanent housing. We've done the analysis through the HMIS data. They don't have permanent housing, so you need to find housing for them. But the remaining people in 37,000 are living in extremely rent-burdened conditions, which means that one adverse effect in their lives, maybe the loss of a job or a healthcare crisis, can easily tip them over into homelessness. So if you're going to start addressing homelessness at its root cause, we have to build somewhere between 16,000 and 37,000 new units that don't exist today in King County. So what's it going to cost us? Well, before we get there, we got to figure out what units are we going to build. If you look at the kinds of homes that we require, let's start from the left-hand side of this. So if you take the 22,500 people that we've had that needed some kind of, that declared homelessness in HMIS data, you can find some fraction of them that you can divert. So you can have some fraction that you can divert through giving them some incentive In fact, this is a very interesting program that King County's run that uses diversion to actually, a very, very interesting way of getting people off the homelessness bandwagon. It's not permanent, but it gets people to be more self-reliant in this case. So a small fraction of that you can address through diversion. We may be lucky to get some incremental vouchers. Very difficult to see that happen today. Section 8 vouchers are typically tapped out. But if you want to be generous, we can add a few more in terms of vouchers. But that still leaves us with a significant chunk that we have to address to get to our 37,000. Now, if you break down these units into categories, you start with the left-hand side. These are individual units. So you've got people that can live, these are single adults that can live in units that have one bedroom. And there are about 23,000 of these individuals. Then you've got the people that are in the family category. So you've got about 4,500 odd people that we need to house that are in the 0 to 30% of AMI that have families. Then you get to if you move further to the right, you get to the permanent supportive housing category. These are people who've got some disabilities or need special services. Those housing units typically tend to be more expensive, and they need to be augmented with services that the state has to provide or the county has to provide. So those units tend to be more expensive. There's about 6,000 PSH individuals, and then finally, you've got a small number of permanent supportive housing families. As you move from left to right, in the middle of this waterfall chart, from the individual to the family to the PSH individual to the PSH family, each unit gets more expensive. So in order to cost this out, one needs to actually look at the economics of building or repurposing units in each of these categories. And so that's just what we did. And what we found is that if you look at today's answer to homelessness, or let's put it this way, last year's answer to homelessness, the county in aggregate plus the city of Seattle together spent about $260 million per annum on addressing homelessness. So that's the aggregate of what we spend today, and that includes all the spend from categories. And there's a small amount over and above this from philanthropy, but it really doesn't amount to this kind of money. And it's essentially a small fraction. Now, if you look at the need to house somewhere between 16 and 37,000 people, and you have to build the units that we just went through on the prior page for individuals, for families, for permanent supportive housing individuals and permanent supportive housing families, it is going to cost us somewhere between $700 million to $1.5 billion per annum for the next 10 years. So that's somewhere in the $10 to $15 billion for the next 10 years. That is just to address the homeless population as of today. Now, we've made some assumptions to get to these numbers. The numbers include assumptions which says there's no increase in the services spend, which is in itself a difficult one to swallow, but we said in the interests of trying to be conservative, let's assume no increase in services. Second, we assume no inflation, which is also a bit ridiculous, but again, in the interest of being as conservative as possible, we assume no CapEx or OpEx increase. And finally, and this is the part that's probably the most controversial, is that we assume there was no increased need for affordable housing, that rents more or less stay at the growth rate of the median income. Now remember, our rents were growing significantly faster in all years prior to 2019. So we've made some very bold and broad assumptions in order to come up with these numbers. Otherwise, if we relax these assumptions, the numbers that you see over here could easily be about 30 to 50% higher. So that's the size of the magnitude of what we as King County need to understand. Now, if you compare this and you say, well, that's a lot of money. That's about $1 billion to $1.5 billion per annum. If we compare this with the opportunity costs of keeping people homeless, you can see that there are three kinds of costs. One is direct cost of the house, direct costs that are incurred. There are indirect costs and there are opportunity costs. And in each of these categories, you've got indirect costs, you've got the shelter capacity that you need to fund, you've got emergency services. On indirect cost, you've got healthcare, emergency room visits, you've got increase in law enforcement and criminal justice. You've got other public services like policing and social services. And then you've got a further loss in things like tourism, local business, education, etc. And we built a model on this. In fact, this is very few people have done this analysis, but we built a model predicated on some work done at Santa Clara University a few years ago for the state of California. And it turns out that our opportunity cost plus the indirect cost plus the direct cost of managing homelessness for people on the street is around $24,000 a year. That's about $24,000 per household per year. Now, if we were to build the number of units that we went through in the somewhere between 16 and 37,000 units, it typically would cost about $17,000 to house each of these households, incremental amounts over and above what we're spending today. So now we do the math and we see that we've got a choice point that suggests that if we actually spend on building and repurposing homes, we could actually be saving money. So the aggregate cost of homelessness, if you take all the opportunity costs and the externalities, is higher than the build costs. So I'll leave you with this as my final slide, but I'll go back quickly to the top of the presentation over here to recap what I just said, so you can be left with the 5 themes that I said. One is homelessness continues to be a growing problem, and we shouldn't be fooled by the dip in the PIT count. It actually has grown since between 2019 and 2020. And even though we've got some temporary relief in homelessness because of eviction moratoria, the problem with homelessness is going to continue to increase. Second, it's not an issue of individual failure, which we often tend to assume. It's an issue of our prosperity that we have to own up to. And it requires us to understand that the fundamental cost is a supply issue, not a demand side issue. Third, if we're going to address homelessness, we're going to have to build more housing, because we can't play whack-a-mole with the existing units we have or try to increase shelter capacity to push things under the carpet. For now, we need to think about actually building affordable housing, and affordable housing mostly for the 0 to 30% of AMI band. Fourth, we're going to have to fundamentally change how we think about funding. And this funding is going to be 3 times to 5 times higher than what it is today. So we are going to have to bite the bullet and figure out what we do in order to raise the kind of money we have to raise to get to the $1 billion to $1.5 billion per annum in King County to be able to fund the building of these. And then the choice point that we finally are left with is, are we better off leaving people homeless and trying to address them with with band-aid solutions, or are we better off trying to build? And so if you do the economics on both sides, it turns out we're better off actually biting the bullet and building this, building our way out of this situation. So that's my presentation. It's essentially a situation that's, if anything, likely to get even worse once the data from COVID come into play. At this point, when we last checked, we don't have scrub data that can tell us the numbers owing to the pandemic. But given the economic ravaging that's going on for all of us in the country, my suspicion is that the numbers are going to be very much more stark and difficult when we do the math next year. But that's where we are. I'll pause now and see if we have questions, or if there's people who can. I don't know what I'm supposed to do at this point.
Currently, there's no questions in the chat box, so.
Okay. Should I stop sharing, or should I?
No, that's fine. Thank you.
Okay.
There is a question. It says, the Federal Reserve has shown more creativity and flexibility lately. Are they doing anything to play a more active role in funding more housing?
It's a good question. It's a trade-off, to be honest. I mean, yes, they have. We can look for lower interest rates, but they've gone as low as they could in terms of what the Federal Reserve can do. I think we've tried, doing the math and penciling this out with low interest loans. It's just very hard to make this kind of math work. I think, bless their souls for trying, but it's just difficult with, interest rates being what the Federal Reserve can control, to assume that they'll go any lower and that we'll be able to get enough builders to actually do something with this. So I'm somewhat skeptical that there's much that'll come out of it.
Right. There's a couple more questions for you.
Okay.
Do you have any incentives for the private sector?
So I think this is it's a good question. Look, the Trump administration put this opportunity zone model out there in 2017 in the tax bargain that we had. The problem with opportunity zones is that other than the fact that they tend to be more of a giveaway to the rich, in some ways that they are, we couldn't actually pencil the math. Now, if you look at the rate of return that a builder would need to actually make the economics work to build a marginal unit, it just doesn't pencil out, even with the opportunity zones and low interest loans and everything, because the total cost that the builder has to incur in our community is around somewhere between $350,000 to $500,000 per unit, depending on if it's a single unit or a permanent supportive housing unit. And the rents on that have to be below $600 per month. It just doesn't pencil out. So unfortunately, I don't see a simple way out of this without new sources of revenues.
There's several more questions.
Okay.
So how did the number 30% come about when it comes to the amount someone should pay for housing? Who do we have to convince to bite the bullet, local, state, or federal?
The 30% of AMI is actually a hard number, which says that if you are, there were two 30%. There was 0 to 30% of AMI, which is purely an arbitrary band. We just do the 0 to 30, 30 to 60, and so on. That was 130%, if that was the question. The other one was, if you're spending 30% of your income on housing, or below 30% of your income on housing, that's a good thing. That's what the HUD recommends we all spend. And so our model was to say, if you're spending less than 30% of your income on housing, then you're in an affordable unit. If you're spending more than that, then you're either rent burdened or in an unaffordable unit or you're homeless.
Okay, one more question. Have you compared the cost to build new PSH housing with the cost of providing rent subsidies to pay people's rent in existing housing stock? And is there data available for the rest of the counties?
Well, we did look at that. The problem is the following. If you give people subsidies, which houses will they go out and occupy? Because we've got a very high occupancy rate. The occupancy rate in King County right now, or not right now, in 2019 was under 4%. Vacancy rate, sorry, not occupancy. The vacancy rate was under 4%, which means, and that, by the way, is some of the lowest in the country. And the reason it's 4% is simply because people are switching apartments. So when somebody leaves an apartment, it takes about a month for it to be cleaned and refurbished before the next tenant comes in. So we are literally running as hot as we can be in terms of housing. So where would we put these people? Even if we gave them subsidies, we would have to try and squeeze them as far as possible and maybe try to shorten the time that it takes to even refurbish apartments. It's not a long-term solution. In the end, you're just trying to squeeze more people into a certain number of units, and there's only so much efficiency you can get. So our belief is that they're really, over the long run, you just have to have more units. Otherwise, you're just playing whack-a-mole. Are there any more questions?
Yes, sorry. It's one of the questions said, what are new revenue sources that should be considered to build affordable housing?
Wow, this is a question I would personally not prefer to answer, because it gets into the realm of politics and policy, and I'd leave it to the good people of Seattle. But I think, you can do the math. There'll be some kind of increases in taxes. There'll have to be some kind of business tax. There'll have to be some some loans. I mean, this is a complicated question, and we don't happen to be, McKinsey is not a policy or a political entity, so we prefer to not answer that question directly. I don't mean to be evasive, but you just don't really have too much of insight into that.
Okay. All right, and let's see, one more question. The solution you present, build housing and save money, is complex, as the savings how up across many sectors over a long period of time. Who takes the lead?
Mm-hmm. This is a very good point. Well, we're hoping that the regional action plan that we've got now, where we've brought King County and the city together under one governance structure, I think that might be the way to start. It's still being formed and all the details haven't been worked out, but that entity could be the one that begins this whole process of trying to address homelessness with the build model. I don't think this is at the end of it, it's going to be some combination of public and private enterprise, because it's not, you cannot rely on just government to get yourself out of this, or we can't rely on just government. So it'll be some combination of public and private, hopefully under the auspices of the regional housing entity that we've now created in King County and the city of Seattle. If we can bring that together under that auspices and under the auspices of that entity, and give it real teeth with a credible individual at the helm, I think this thing can be solved. It is a long-term solution. It's not going to be, even if we had a magic wand, it is not feasible to build, a 37,000 units in 1 year. We can build at most, some small fraction of that, a few thousand units a year. So this is a long-term answer that we're just going to have to get used to.
So if we're doing okay on time, I will give you one more question. Can you explain the difference between the last slide, which says that you save money spending money on housing versus homeless services, versus the third to last slide, which says it will cost 1.4 billion per year for 10 years to build this housing?
Yep. The number of 17,000, which was on the last slide, per family was derived based on the $1 to $1.5 billion. Because what we assumed was that each of those units, depending on whether they were built in year 1, year 2, year 3, are amortized over a 30-year period. So it's a complicated formula because you have to look for depreciation of those units as they get built, and then look for the total cost that you can attribute to that unit. And that turns out to be $17,000 per year per household if you built all the units that we said you'd need to build. And that's the comparator between the 24,000 leaving people as they are versus the 17,000 per unit spend that you would have to incur. And that's the difference. Okay.
Okay. Do you have more time to take another question?
I'm happy to take time. Yeah.
Okay, great.
I can't see the questions, so my apologies.
Right. No worries. I can see them, and I'm the moderator. I'll try to read most of it to you. So the other question is, does the analysis factor in the fact that folks, especially single folks, at cohabitating multiple folks per apartment or house, as it is more economical on those involved and they become less rent burdened?
So sorry, I missed the question.
Does the analysis factor in the fact that folks, especially single folks, at cohabitating multiple folks per apartment, as it is more economical on those involved? Yes.
Yes, we did actually look for ways to squeeze more people into sharing apartments, and that was factored in on a prior slide, where we looked at all the ways that we could squeeze the efficiency. By the way, we also looked at ways to make the crisis response system more efficient, to move people into shelters. So we put as much as we could before we built. So building was what I'd call a point of last resort. It wasn't like anybody wanted to build these out, because we know how difficult it is to go through all the siting permissions and do zoning changes and all of that. So it was literally a point of departure for a last resort solution. So yes, we did look at that, and but it's de minimis relative to the need. You can squeeze so much, but not a whole lot.
Okay, another question. Do you think if zoning were to allow for more density, for more units, if builders were to build affordable units for low AMI, would help?
Yes, in fact, it's not just would help. It's mandatory, because we don't have. Remember, we have to build where jobs are, because we don't have a great transportation system. If you go and you build on the east side, and it takes people 3 hours to get to work using public transportation, people won't live there. So we've got to build it where there's transport. And in order for us to do that, we're going to go through some more densely populated or more homes or more areas that require us to relax some of our zoning constraints right now. So yes, I do feel like it's going to be pretty important. Now, whether we swing all the way and become like Minneapolis, I don't know, where they've basically said no more single family homes. I think that's maybe a bit extreme for some people, but we can't live with the zoning restrictions we have now. We're just going to have to figure out ways to get past it, which is the other reason why I didn't want to get into the whole issue of policy versus politics and where the money comes from, because we have to address some of these zoning issues on the head.
Okay, one last question. Do you think if the building and permitting allowed for little or no fees for permits to build affordable housing for low AMI income, do you think that would be helpful?
I don't know if it's a fee issue, to be honest. I think the fees are not as big an issue. And the reason I bring this up is actually, if you look just further south into the state of California, Santa Clara County has got over $1 billion already. They've already got a bond for $1 billion, and the money exists today in the bank, but they haven't built a single unit. And the reason they have not built a single unit is because siting restrictions in California are some of the most stringent in North America. And ours are a little bit easier, but we have siting restrictions and zoning laws that are pretty tough. And so at some level, it's not so much about the fees, it's also the personal will of the individuals who live in areas to allow for changes in their zoning laws, to allow for more multifamily dwelling units to come out. And so there's a lot of give and take that needs to occur. And so my own view is that the fees themselves don't really change the dynamic a whole lot, that it's actually political will and personal will that's going to be more important to this for the citizenry.
Okay, I believe that covers most of the questions we had in the chat box. Thank you.
Thank you very much.